presentation today that includes both some advice and some experiences while he was a student and how that helped his career, as well as going through a few stocks. Just like everybody else, he'd love to hear questions along the way and ask him what you want to know. Thanks, Nick.
Thanks, Dr. Mark, for having me. Like you said, I'm Nick Jansen, 2006 grad. I did an undergrad here as well. Sorry I'm staying back here. The clicker doesn't work. But loved the experience here, and I was happy to, when Dr. Brown gave me the call to come back to kind of share some experiences, get you to know what kind of equity research is. I know Raymond James has some interviews upcoming over the next week or two, so kind of give you some advice on that front. I was sitting on your side getting interviewed and done the interviewing myself for future candidates, so I can perhaps provide some good advice on that area as well, and then kind of move into what is research, kind of some examples of winning and losing in terms of good calls, bad calls, some real examples that I've been involved in over the last 7 years. Kind of a day in the life of what we actually do. Talking to the lunch group earlier today, they'll let you know that there's really no typical day in terms of the research side of things. And then lastly, kind of give you the pros and cons of research relative to some of the other areas that you're probably looking at. And then finally, some last-minute career advice, should you guys want to listen to it. In terms of from MSF to Raymond James, I did undergrad here. When I was here, there was no 4-year program with MSF. It was 4 years of undergrad and the 1 year of master's. I had the dual degree of finance and economics, but I didn't really have the job experience or perhaps the financial grasp to really understand what I was going to be doing with my life. So I effectively joined the MSF program. It was a great ride. I was still during the first summer. I remember still not knowing exactly what I wanted to do. And I'm not sure if Jason is still here. I don't think he is, but Dr. Karseski's asset allocation class, we had to build a portfolio optimizer, dealing with, and I think we're doing this now. You guys were talking earlier about kind of an investment program, but clearly I found a passion for stocks, picking areas, sectors, tracking benchmark portfolioing. So with that passion, I obviously delved into the capital markets arena. Obviously there's different track routes of banking, research itself, buy side or sell side, and eventually I chose research because of the fact, in my mind, the day-to-day volatility, loving the stock market, it really my passion, and that's kind of how I chose that route. I had a couple offers coming out of grad school, fortunately enough, and I chose research. And the Raymond James appeal, there's kind of multiple reasons for that, and I'll get into that a little bit later. In terms of the recruitment process, I know that's probably what a lot of you guys want to kind of figure out in terms of how you go about in terms of submitting, getting into equity research. Obviously with Raymond James, you submit your resume through the CRC. I was telling these people at lunch today, I don't think work experience is everything. My resume when I was coming out, I definitely did not have the work experience. I was actually a swimmer here at UF for a brief period of time. I did more swim camp work and volunteer work with the swim team during my summers versus going to New York or anything and getting the experience that you need to kind of participate today. But I think what got me the job and what got me several offers was just the combination of understanding what I wanted to do and showing them that I had the passion, the knowledge, and the hard work ethic to do it. So I think when you sit through these kind of on-campus interviews, you want to differentiate yourself, but you want to be yourself. You don't want to have canned answers. You don't want to have what you think they want to hear, because they're going to hear that the on-campus interview day. They're interviewing probably 15 people over 30 minutes each time. They're going to hear a lot of the same exact responses over and over again. And the way you differentiate yourself is what stands out. So after 10 hours of interviewing, I'm going to talk to the guy next to me, because it's a two-person interview, and say, who really had the best answer for this question? Really, who stood out? Who really understands what research is, what the markets are, and who can really do this job? And I think if you're able to differentiate yourself, but not give that canned delivery, it certainly goes a long way in terms of perhaps being invited back to kind of Super Day Just to let you know, verbal and written communication are very important. I struggle with verbal communication, as you're probably hearing now, scattered left and right. Having a clear, concise answer is what they want to hear. The buy side gets thousands of calls, thousands of pieces of research a day. If you're trying to explain something in a 5 paragraphs, they're not going to read all 5 paragraphs. They want to know the conclusion right up front, the answer right up front. So being effective in your communication, both verbally and written, is very important for the job. So I'm not sure if you know too much about research, but written communication, I spend 30 to 40% of my time writing reports, and I think you kind of have to get a sense of that dynamic. And I actually have some reports here if you want to pass them around. Just a couple. I'm in the healthcare sector. These are some of the larger reports that were written over the last 6 to 12 months. You guys have already seen them. But so round 2, once you get back to if you are selected in terms of getting into the home office visit, there's usually 4 people who are interviewing you. You take some other tests as well during that time frame, but you typically have one guy who's the hard interviewer, you have one guy who's the laid-back interviewer, and then you have something in between. But know your current events. They're always going to ask you about current events, so make sure you know where the stock market is, and make sure you know what the Fed just announced yesterday. Make sure you know these things because they're going to come up during the process. And if you don't know those things, it means you're probably not involved in day-to-day market activity. And literally, I have a computer screen just in my office of all the stocks and tickers that I cover. So certainly, I'm monitoring minute-by-minute movements in the stock. So clearly, you need to know what's going on in terms of the markets as a whole. And also be prepared to pitch a stock. You're going to have typically, I always like to ask a question. Give me your favorite idea in 30 seconds. So why you like it, why you think it's a good buy here. I think if you don't have, if you're not effective in communicating that, you're really probably not going to be effective in doing the job. So it shows that you understand what research is all about. And then final selection is, I think Super Day this year for Raymond James is October 19th, I believe. You have final selection and job offers, and certainly, hopefully, you guys have multiple offers and multiple avenues of career path. But why Raymond James for research? This is why I chose Raymond James for research. Conservative culture. It's Raymond James is different than a bulge bracket firm in New York. It's much more laid back. It's much more teamwork oriented. It's much more conservative the way we kind of approach things. So there was no major job reductions at Raymond James, unlike you saw, massive layoffs on Wall Street. We had positive earnings throughout the financial crisis, so we're certainly not involved in, lending out aggressive mortgage-backed securities and things along those lines. So certainly there's a lot more stability at Raymond James relative to some other areas. You could say that's a good thing or it's a bad thing. It's your point of view, but that's the way Raymond James was founded, and that's the way it's probably going to continue to be operated. Greater exposure to the buy side and management, in my mind, when you're at a bulge bracket firm, when you're a research associate, so right out of school, when you're a research associate, you're probably in a bulge bracket firm just doing modeling, just doing the writing. You're not getting the exposure. You're not going to management meetings. You're not going talking to clients because your analyst wants to get the most exposure because they get paid off of, if they're institutional investor award or they're in the Wall Street Journal or things along those lines. So clearly, the bulge bracket firms for research associates, you probably don't get the level of exposure that I get. So when I first started, I had a lot of responsibility from day one. I had access to all the management teams that we have under formal coverage. I have for some of the examples of the companies that I cover, I do healthcare services, pharmaceutical distribution, diagnostics, so clinical labs. So for example, I'm sure you guys know what LabCorp and Quest are, the big clinical labs. I have the phone numbers of the CEOs, the emails. I can call them whenever I want. So I don't think you're going to get that level of exposure as a research associate at some of these bulge bracket where you're more of, you're not one of many, so to speak. Plus, in Florida, there's no state taxes, so that's always a good thing in terms of thinking about your financial, your career. On the downside, there are some negatives about research. Unfortunately, there is less respect for smaller not bulge bracket firms. It's something you kind of have to work your way through. There are fewer financial resources, so we're not given tens of millions of dollars in terms of budget to buy. We're using this example at our lunch today on the device side. I can't spend $10,000 and call the John Hopkins people who implant this device and basically have a 2-hour conference call with buy-siders calling in and ask about it. We just don't have those level of financial resources, so it certainly is a headwind that you have to deal with. So when you're a smaller firm, you got to pick your angles. So for example, when I launched coverage on the diagnostic space, most of the diagnostic analysts out there were all on the medical side, PhDs, they know the science behind everything, where I don't have a PhD, so where I come from is I cover healthcare services, so I know the hospitals, the volume trends, physician offices very well, whereas the analysts, on the other hand, are more science-oriented, so they don't know what's going on at the hospital level. So I bring in a different vantage point. You got to find where you add value and exploit it, because if you're not a bulge bracket firm, it's tougher to get the biggest meetings, to have the Fidelities of the world want to talk to you versus JP Morgan, for example. And then obviously advancement challenges given geography. Raymond James is located throughout the U.S., but we're headquartered in St. Pete, and most of the research positions are in the home office. So there's not, if you want to move beyond sell side research, if you want to go to the buy side, if you want to go to private equity, there's not a lot of Tampa shops. So to get the networking capability, it's a little bit more challenging, but it's certainly overcomable. What is equity research? It's certainly the backbone of equity capital markets. It drives iBanking, sales, and trading. Certainly, sell-side research, you technically don't get paid for what we do. Fidelity isn't paying us, writing me a check for my research. They're trading. If they like what our research was, they'll trade through our trading platform. They'll give us votes, and those votes turn into money eventually. But research is a cost center, whereas sales, banking, those are all kind of revenue drivers. But equity research is the driver of all those things. Our sales force, we have a morning meeting at 7:20 every morning. We have an afternoon meeting at 2 p.m. So the research is published in the morning. If someone's upgrading or downgrading a stock, the sales force will listen to that analyst's presentation of why they should buy this stock or sell this stock. And from that standpoint, the sales gets on the phone and calls all their clients that day. So, but without research, sales really has no responsibility. Same thing with investment banking. Obviously, when you're a banker pitching a small company about why they should be using Raymond James, certainly our research platform gets them excited. Our research gets disseminated through 6,000 retail brokers. So certainly, having that backbone of research certainly helps pitch deals. And then, I think that's the general thing. Understanding research terms. I'm sure you guys know this, but on the buy side, those are the actual guys who are buying and selling the stocks. They're using, they're consuming the research that we provide them. They tend to be generalists. But you do have sector-specific hedge funds who will just be healthcare only, so you'll have some specialists in that front. But most of the time, on the buy side, you're more of a generalist in a space versus on the sell side, which I'll get to in a minute, is very specific on that sector. So I know my 36 stocks like the back of my hand, but beyond those 36 stocks, while I know other areas, I know other sectors, I'm not as fluent on what Walmart's doing in terms of their dividend policy relative to what HCA is doing in terms of hospital reimbursement. So it's certainly a little bit more different. On the buy side also, you're compensated more on your stock selection, so it's how well you do in terms of your research calls, so to speak. And considering that your compensation is based on how well your stocks are, you're certainly a lot more less job certainty, because if you are wrong more than you're right, then you're likely not going to be at that space for too long. On the sell side, obviously we issue buy and sell recommendations. We are deep in our coverage, specialists in nature. We write the research as you see those reports that are out there. We provide the service, and compensation is more variable. It's not really dependent. It's somewhat dependent on being right and wrong, but there's other factors associated with that. It's not all just the stock call or not the stock call. So like I said, there's more career longevity on the sell side, but it can be a little bit more mundane. So starting by initiating research coverage, so last July, I was predominantly just still a healthcare services and pharmaceutical distribution analyst, and they asked me to basically launch coverage on the diagnostic space. So Raymond James had never covered the diagnostic space before last July, so I basically was starting from the ground zero. I wasn't replacing someone who already had all the models built, who had all the reports kind of already there that you just had to add to. So you basically have to read everything on the industry and the company. So you rummage through all the press releases, the transcripts, the SEC filings, you read the 10Ks, the Qs, go to the company websites. Then you start kind of formulating the Excel models, utilizing all that data. You go to visit with the company management. You talk to private and public competitors. For example, on Monday of this week, I was actually in Philadelphia meeting with a small diagnostic company called OraSure, who does HIV and hepatitis C diagnostic testing. So that's a company that I'm looking to launch coverage on. So it's one of those ones where I go see where the things are made, meet the company management, meet the employees to get a better sense of what's going on versus just listening to them on the earnings conference calls or the transcripts. You develop a thesis, and then you write a research report. I think one of those reports, the one that's VCA Antec that was passed around, that was kind of an initiation of coverage report. It's anywhere between 30 to 50 pages. It talks about your thesis on the stock, why you like it, why you don't like it, your earnings estimates, how you differ from consensus. But it also gives you, a general business overview. These pieces are meant to have shelf life. So, for example, an example I gave earlier today, Fidelity turns over their buy-side analysts very frequently. So they rotate between healthcare, other sectors quite frequently. So they need to so the new guy replacing the old guy doesn't know anything about healthcare, and they need something to ramp them up very quickly. So if you have a report that's out there that's long in nature that they can better help understand the business model of what they do or what they don't do, and you can be that go-to guy for that Fidelity analyst, you're going to make the firm a lot of money. Fidelity is our largest customer, a couple $1 million a year in commissions from trading through them. So if you're able to be the Fidelity's go-to guy on diagnostics, you're certainly going to be making the firm money, which certainly bodes well in the future for you. Beyond the initiation and recoverage, you basically have maintenance reports and updates. So every time a company has a press release that's material, you'll put out something in terms of an updated report. Is this conflicting with your thesis? Does this go along with your thesis? Does this drive your price target higher, estimates lower, estimates higher? That's kind of the basic. And then also on the quarterly earnings report, so once a quarter, the company reports their results, and you, like the other 20 guys covering the stock, put out a report saying, good quarter, bad quarter, and the like. Mm-hmm. Right now I cover 10, and I'm launching on another 5 by the end of the year.
What's kind of the calculus as a subset?
Mm-hmm.
What were the kind of criteria that you thought about one initiating that one?
It's a great question. When we talked about this some at lunch. First, within the diagnostic space, most of these companies are smaller. Other than LabCorp and Quest, which are just the big clinical labs, these are smaller companies that are developing new technology to discover, does this person need chemotherapy or not with cancer therapeutics. So investors love top-line growth and showing growth. So I'm choosing stocks that I think have, A, the technology to be a game changer, or B, that have big moats around them in terms of market share and a big breadth of product portfolio that will help them continue to grow top line even if one of their businesses starts to slow relative to others. So I tend to look at top line growth in the diagnostics, but that's completely different than other areas. If you're looking at commercial insurers, for example, or HMOs, there's like I think 10 publicly traded HMOs, and those are the 10 you're going to cover because that's all there is. But in the diagnostics, there's hundreds of small to mid-cap diagnostic companies that are out there that I could choose. So you want to go with technology and top-line growth, and the ones that have the successful change to kind of change the way healthcare is done in this world over the next 10 years. Exactly. The ones that want investors, so they might be small today, but they'll be mid-cap, large-cap eventually, or they'll get bought, which will give the investors the best return. So, you could also think about, we're talking about the buys that I'm looking at. Conversely, if you find a company that maybe their technology is lagging, maybe they're slow to the gate, their new products aren't gaining traction like you thought they would, you can come out with a sell rating, and so you kind of look at it in both ways. But starting point for a young analyst, you don't want to ruffle too many feathers so you just kind of pick your spots, so to speak. But that's kind of well, I would say from a sell side standpoint, from you're going to the management, you're trying to build yourself up, build up Raymond James, because a management team could not be that receptive they don't want any more sell-side coverage. They don't want you covering them, so they're not going to give you any data. So, if you want them to kind of help you out along the way, you certainly want to have more of a positive view on the companies that you are going to cover versus negative view. And, that's the unfortunate beast of the game. That's the reason why I think if you look at combined equity research, not even just Raymond James, but throughout the industry, of all the companies' stocks that are covered, I think only 10% in total are sells. So, that's not really the reality of the market, but that's just the reality of kind of the research business. So having a sell rating is somewhat of a negative stigma, so to speak. Exactly. Especially, if something changes in your thesis, it's perfectly fine, but to come out with a sell after the management team has been very helpful for you to launch on them, it's a tough stomach to. You're not going to get them to come out on the road or market with you with that level of. Unfortunately, that's just the way that the business works.
How would you compare the culture of equity research versus S&P or capital markets research?
Well, I would say the culture of research is probably a little bit more laid back, at least at Raymond James, relative to banking. But banking, you're traveling a lot, you're pitching ideas to companies. It could be very boring all day, and then all of a sudden at night you have to work all night because some idea came up. So it's in my mind, since I haven't basically been in banking, I can't really give you an experience of what my friends who are in banking would tell you, is that sometimes it can be frustrating that they're playing solitaire all day, and then at night they have to work until 2 in the morning, and kind of repeat the cycle. So research, you're basically you're monitoring your stocks. They go up or down every day in your office because when the market's open, you're in your office or tracking it mobily or whatever. But there's a lot more excitement in my mind in research, given and we'll go into a little bit more detail about kind of the day in the life, but every day is different, and it sounds kind of cheesy and canned, but it really is. I could think about going in the office today, and maybe it's a Friday, thinking it's going to be a light day, and one of my companies gets acquired or pre-announces negative earnings, and I have 50 phone calls, a pipeline I have to go through, not to mention writing a report, updating the model. So it can just be very hectic, which I think is, in my mind, it's more exciting. But I can't give too much comments on the negatives of kind of comparing it to banking.
When you're initiating coverage on a company, do you take into account like the potential trade risk, volume of shares that are being traded? Like if nobody's interested right now in the buy side, portfolios, is that something you have to take into consideration?
Well, my trader will tell me yes. He's like, "Why are you issuing on coverage that no, I'm not going to get any volume through?" But yeah, going back to Dr. Brown's original question, for diagnostics, I viewed revenue growth as an area of focus, but I also viewed how many sell-siders were also covering the stock. How could this company be? How can Raymond James as a whole entity, trading, investment banking, corporate banking, help this company? So there's a lot of factors that go into the decision of who you launch on and who you don't launch on. But yes, volume and liquidity, because if the buy side doesn't want to own it and it doesn't trade, it's okay to cover the stock, but it's not going to be exciting coverage because no one's going to be calling on it. You're not going to take this company on the road because no one's really want to see him. But so certainly, yeah, market cap size matters, and so does liquidity on the volumes side. Yeah.
I was going to ask about in regards to
Mm-hmm.
how do you
So let's say it comes out at 7 a.m. Press release hits, you print it out, you basically plug in the numbers relative to your expectations, your model. And typically, you know the earning, they tell you what day they're coming out with earnings. So for what we like to do is we come out with a first take note and then a follow-up note. So the first take note would basically, I can probably pre-write a lot of that the day before, hoping that I'm correct in terms of it's going to be a great quarter, it's going to be a bad quarter, use the right words associated with that. And if that's the case, I can get a note out within an hour and have it published and disseminated to all the buy-siders out there to say, here's what our first take thoughts are on the quarter before they host their quarterly conference call or before we have a chance to catch up with management to kind of discuss some things. And then after the quarterly call, we'll like to follow up with a more detailed note of, here's our model changes, we're keeping with our recommendation, we're lowering our price target, raising our price target. If at 7 a.m. the numbers are just terrible and it's just what you said going into the quarter was they're going to beat because of X, Y, Z, and basically they missed because of X, Y, Z, and that changes your thesis, then yeah, you could downgrade it before the market opens. But to let you know, the buy-siders really hate reactionary downgrades and upgrades because it really adds no value to them. They want to buy something or sell something before the news happens, not the day of the news. So you got to kind of take that into play of I could tell you that most times that I'm on the phone with buy-siders, they don't ask me what my rating is, they don't ask me what my price target is, because they're doing that work on their own. They're using me as an information source of, I know this company like, I'm one of 5 analysts who cover it. I know everything about this company. This buy-sider covers 1,000 stocks. I cover 36. I'm calling you to help me better understand this company, the pros and cons, the opportunities and the risks, and they'll make that final decision because at the end of the day, it's that analyst, buy-side analyst, who's recommending that stock to the PM. If the PM, and if that stock blows up, the PM's going to say, hey, analyst, what was wrong? And if he said, oh, Raymond James told me to buy it, the PM's not going to be, that's not the answer he wants to hear. So I'm more of an information source. You'll get some people who like buys and who will ask about the price target and things along those lines. Hey, it's reaching your price target. Are you going to downgrade the stock? You kind of have the buy side try to, for a lack of better words, manipulate the way you, because certainly they want to have their portfolio do well. So they're going to say, hey, the stock's at your price target. You should downgrade it because there's reasons behind all that, and there's games that are played. But for the most part, you can get the first take note out and full coverage note, within that day. Yeah, that's the point of it, because if there, it's one thing if you're the only analyst covering a stock, but we cover CVS and Walgreens. There's 30 guys covering it, and if I'm the 15th guy out with this quarter was okay because X, Y, Z, no buy-sider is going to read it. So if you're the first one out, they're going to be like, oh, wow, let's ping him. Hey, what do you like, what you don't like? And then if you're good at what you do, they'll probably maybe buy or sell the stock through your trading, or sell another stock to Raymond James through our trading platform. So kind of going into a day in the life of an analyst, it's very atypical day to day, but in terms of what's going on during the day, the hours are pretty typical. You're there for at least 12 hours, kind of sunrise to sunset. It's information overload. You have constant communication. I get thousands of emails, calls all day long. Monitoring all the flow of activity is kind of it can be a challenge at times, especially during earnings season. If you have 7 companies reporting that day, it's going to be a busy day, and you're going to have more than that. For a research associate, you're going to be in your cubicle, and you're going to tend to not see the light of the day. But it's certainly a good experience in terms of learning experience and activity and fun on the job. Like I said, most of the days on the phone or monitoring daily market activities. Customers are calling in, either asking, hey, did you see Credit Suisse's downgrade of this stock? Do you agree, disagree? Why do you agree, disagree? Does this impact your view on the stock? Dealing with industry news, let's say Medicare. So I cover the healthcare space. CMS, the Centers for Medicare and Medicaid Services, they'll come out with press releases saying, hey, we're changing the way we reimburse hospitals. That minute that press release comes out, I'll have 10 buy-siders call me. hey, is this good or bad for HCA, which is a hospital chain, and why? Is the numbers going up, numbers going down? Is the stock going up, going down? So, you're certainly monitoring a lot of the daily activities. I travel once a week on average. Like I said earlier this week, I was on Philadelphia. Next week, I'm going to Chicago, Kansas City, and Denver, meeting with some buy-siders. Also, you're meeting with management teams. You're attending industry conferences. There's a big diagnostic conference in Boston in early October that I'll be attending. So, for an analyst, you're traveling a lot. For an RA, you're probably not traveling much. Depends on which analyst you have. So, it's kind of an interesting dynamic. Every analyst at Raymond James is different. They like their RAs to be different. So some analysts love their RAs to just do modeling and writing, and the analyst is going to be on the phone all the time, and he's going to be traveling, and the RA is responsible for building the Excel models, writing the research reports, and getting that done. Other analysts are really hands-on in the model, and they really want to know what's going on with the numbers, so you're more in tune to writing, perhaps traveling a little bit more because he wants to be in the office all times kind of dealing with the numbers. I was lucky enough to have my analyst when I started in 06 was very hands-off. So while it was certainly a lot of work to ramp up in the beginning, it certainly paid off longer term. The progress that I've made, the track that I've done at Raymond James is all because of him. And by having that hands-off approach, the sales force got to know me better, customers got to know me better, management teams got to know me better, and it's put me in a position where I can call LabCorp and Quest CEO and not look like an idiot. But I would say there's more writing than modeling. So if you don't like writing, research is probably not the area for you. As you saw, some of these reports are pretty labor intensive in terms of the size and how much time is putting into them. Modeling, really the only time you deal with the models, A, is when you're initiating coverage and building out a model. B, when you're updating it for earnings or some other exogenous event. But to be honest, you're writing more or you're on the phone more. So I think verbal and written communication are much more important than being an Excel wizard. So like I was telling the group today, you don't need to know VLOOKUP tables. You don't need to, I can't tell you the last time I did anything along those lines probably since college. So it's much different in real world relative to academic setting. So kind of go back to the research associate responsibilities a little bit more. Depending on how well you can do, your analyst, the ramp up period to becoming a research associate is pretty intense. So typically you start on July 1 for the way the Raymond James structure works, and it's different for everyone, but typically the RA starts on July 1. They have 2 weeks of kind of intense training of just getting to know the processes and the systems of Raymond James. And then all of a sudden after those 2 weeks, you're right into the heart of earnings season. So you're basically thrown into the fire. And if you survive that first earnings season without hating the job, then you're probably going to like what you do for a longer period of time. But it takes about 6 to 12 months to ramp up. I cover 36 names, and each 36 names is different. It's not like if you cover some of the consumer names, so the difference between Home Depot and Lowe's is not that different, but the difference between a company doing HIV diagnostics and cancer diagnostics is completely different. Covering a hospital versus a home health versus a hospice versus a dialysis center, they all have different reimbursement policies. So it takes a while to ramp up, but once that light bulb goes in your head and you understand it, it's kind of like the best feeling that you'll ever have. And then from there, your analyst gives you more responsibility, you get more seniority, and you start liking the job more because you'll get more calls. And I think probably most of you would agree that talking to people about, here's why we like a stock and you should buy it is a lot better than typing away Excel models. Yeah. I am involved. Raymond James wasn't a global settlement firm, so we weren't involved with the major Chinese wall restrictions between banking and research. So on my drive up here this morning, I was on the phone with our bankers. So yes, if they're trying to be a lead underwriter or a co-manager on a deal, there's a committee, basically equity capital markets committee, that listens to both banking and research. So we have go up to the big boardroom and we tell the committee why we think this is a good deal for Raymond James to participate in. if banking's trying to pitch an idea that we know is terrible, and research is going to come out with a negative rating, our capital markets committee will not let us participate. And we've turned down deals before because we thought they were bad deals for the firm. So it's not a good thing when you do a lot of work and you turn it down, but that's the reality of it. But other firms, there's probably a little bit more restrictions on communication between the two. I can't email any of my bankers, so there's no email. So if I sent an email to one of my bankers, they'd fire right back at me. But we can call, we can talk on the phone, we can meet in person. But some of the global settlement firms, it's funny. If someone in research is having dinner with the management team, and a banker walks by and says hi, technically they're breaking the law because the research in banking can never pitch together to a management team. I would say my compensation is more derived about individual performance on kind of stock picks and calls. We work as a healthcare team, so there's 6 analysts covering on the healthcare side. I think about 120, 125 healthcare stocks broken down between medical devices, diagnostics, hospitals, managed care, things along those lines. So we do put out combined reports sometimes, but for the most part, our compensation is derived towards your individual performance. And if you're right 51% of the time, you're probably still going to have a job. That's the kind of the nature of the business. Yeah, it's 26 names right now I work with another analyst on where he's the lead and I'm so on the reports his name will be above my name. And we work as a team, but he gets credit for those 26 stocks. For the diagnostic names, the 10 that I talked about, I'm the sole guy on the lead and I'm in charge of everything. So if my 10 stocks are doing great and his 26 stocks calls are doing bad, it's more a reflection of him relative to me. That's kind of the way the structure works. Yeah. That's a great question, and unfortunately, each shop is different. But that's why we have sales guys. So basically, a sales guy will be the kind of intermediary between an analyst and the buy side. So sometimes a sales guy will call the buy side guy and just pitch the idea based on what the analyst said in the morning meeting. Sometimes the buy side guy will want more questions other than just kind of the 30-second pitch, and then the sales guy will direct them to the analyst. So the sales guy knows exactly how much contact is being done between the analyst and the buy side, and it's their job to make sure that the buy side then pays us. And if there's issues there's votes, and it's actually quite structured, to be honest. It's called a chit system for some of these things, where every time I talk to a Fidelity counterpart, they marked it down, and then at the end of every quarter, they pass that along information, and we get paid on some of those chits. Other times, it's paid just through trading, so you got to hope that they utilize. But if the sales guy sees that, hey, they're free riding off our research, we're going to knock them off on how much coverage we give them. So with the chits, there's actually yes. Mm-hmm. Or not to me, but to the firm, and eventually, hopefully, to me. Yeah.
So some of these small to mid-cap healthcare systems cover this coverage. So does that allow you to differentiate yourself from all of these systems?
Yeah, I think the small to mid-cap, like going to where Dr. Brown started a lot of this conversation was when I'm choosing areas that I'm focusing on, I don't want to be the 25th analyst covering a name. Well, I might have to cover it because, it's the industry bellwether, so I have to cover it. But yeah, that's why Raymond James focuses more on small to mid-cap research, because there's more value add there, because there's maybe 5 to 15 analysts, not 25 to 30. So when you have some of these smaller companies, yeah, the company I talked about going to Philadelphia for, there's, I think, 4 analysts covering it right now. It's a $500 million market cap company. I can add a lot of value relative to if that was CVS and it was, I'm the 30th guy out there who, it's pretty predictable what their number's going to be. The smaller companies, certainly, if you're right on the technology, the revenue skyrockets. So you could have, you see a lot variability in terms of the earnings estimates out there for smaller companies versus larger companies. So for CVS, for example, for next year's earnings estimates, consensus is like 370. The range is like 360 to 375. It's pretty tight. For this company I was talking about for next year, the range of revenue, they don't make any money right now, but the range of revenue is 100 to 130. That's a pretty big variability relative to, so you can certainly, if you're right, you can certainly become kind of the bellwether analyst for that stock if you make a good call. Just want to kind of give you some examples of just, Dr. Brown wanted to kind of show some examples of some calls that we've made, right and wrong, that kind of show what we're doing on a daily basis. But the first one's about Rite Aid. I'm sure you know it's a big, large drugstore. It's the 3rd largest drugstore in the U.S. They made a big acquisition back in 2007. They acquired Brooks Eckerd. To do this, they layered on a significant amount of debt. They issued equity, and they added a lot to their risk profile if the merger didn't go through, the synergies didn't develop, if the costs weren't reduced. At the time, you had Jim Cramer, everyone knows Mad Money. He was pumping the stock, hype on the deal accretion, the potential equity returns, because when you layer on a lot of debt, you certainly can get a lot of equity value, assuming they can pay off the debt and it just transfers to the equity holders. So the stock rallied during the kind of the ensuing 10 months. We basically had a sell on the stock when the deal announced, and we kind of kept that sell throughout this whole process because we said, hey, drugstore fundamentals are weak. Brooks Eckerd stores were highly undercapitalized in terms of the investment into them. The economy was heading into a recession. So we kept we kept our view even though we were kind of fighting the momentum of the stock. Eventually, the synergies didn't develop. They turned negative free cash flow. Their leverage increased to north of 6 times, and the stock almost went to bankruptcy. So, I think the reality of it in this example is, we always like to look at free cash flow. It's certainly very important. Some sectors it's more important than others, but certainly in retail land, free cash flow is very important, as is kind of your asset base and Rite Aid stores. Kind of going into the fundamentals, I don't want to get too specific, but certainly their locations were BC real estate versus kind of A real estate for Walgreens and CVS. So, the story here is sometimes you can be wrong. Sometimes it takes a while to be recognized for a good call. Secondly, on kind of a negative standpoint, yeah.
Back on Rite Aid. Were you receiving a lot of pushback from management of Rite Aid?
Yeah.
How'd you put up with that?
Well, I think you manage it. You don't want to be defensive, and I think management teams. The sign of a good management team is they don't really care what research says. That's, in my opinion, management teams shouldn't really care about their stock price value, or the stock's going to. They shouldn't be cared about the multiple. When they talk about, you should be upgrading our stock, they should be focusing more on their business, and we should be focusing on kind of how we value the business. And don't get me wrong, when you have a sell rating on it, they're not happy. But I think when they're aggressively negative about your sell rating, it kind of goes to show you that they're, unless you're just truly wrong on what you're saying, which none of these things that we were wrong about in terms of everything we said they agreed with, but they just said, hey, we should be a buy, not a sell. So it's one of those ones where you manage it. Unfortunately, you're not going to get much love from them from taking them on the road or participate in their next deal or anything like that if you're a sell. But that's just kind of the way you manage it. On a negative call, in terms of sentiment, in my view, is more important than the fundamentals sometimes. The fundamentals can be fine, but the stock could be cut in half. And sometimes you just can't fight that. You can't fight the tape. So, Healthsouth, they are a very large inpatient rehab provider. I'm sure you've heard of their major fraud, Scrushy. But this is the new Healthsouth, not the old Healthsouth. So they had a brand new management team from mid 2008 to 2011. They were recovering from this fraud that basically almost put them into bankruptcy. They had strong performance. They delevered the balance sheet from north of 6 times levered to under 3 times. Their free cash flow improved significantly. So while the valuation started to recover, Healthsouth became everyone loved it. It was a name that everyone loved. They thought it was a safe name to be in. We had a strong buy on it. We continued to like the risk reward. And then all of a sudden, last summer, you had the U.S. debt downgrade. President Obama's budget that came out in September. It kind of sparked fear in all Medicare providers about potential reimbursement cuts. Healthsouth has a big amount of Medicare exposure given what they do, but they were very transparent on, hey, if this president's proposal went through, it would impact us X, Y, Z. But despite that, and these cuts were not going to impact their growth profile whatsoever. It might slow from an 8% grower to a 5% grower, but we're not talking about this company going from 8% growth to cut their EBITDA in half. But doesn't matter. Stocks sold off. They cut the stock in half, despite having a robust free cash flow yield. And shares still haven't recovered to where they were. So a year later, there's still this sentiment about potential, what's going to happen because 70% of their business is Medicare. So I think just generally speaking, sometimes fundamentals don't matter. I actually had a buy-sider call me on this last September, and his exact words was like, I love this company. It's a great company, but I'm going to short the stock because it's going to continue to go down because fundamentals are weak. Or not, because sentiment is so weak. So until you get that sentiment to turn, unfortunately, the stock's going to be under pressure, even though fundamentally nothing happened. The company's EBITDA continued to grow. These cuts were eventually taken off the table. But during that 3-month time frame when everyone hated Healthsouth, our strong buy rating looked pretty foolish. But it's one of those ones where our strong buy rating was on the fundamentals, and unfortunately the sentiment turned. Yeah.
How do you handle speculation?
Well, it's not fun. When you get a call wrong, it's like a punch. It's like a punch in the gut. Particularly if you're making a bold call. If you're downstairs at the morning meeting telling your sales guys they have to call all their clients because you need to own Healthsouth because X, Y, Z, and this was when the stock was $25, and then all of a sudden the next day the budget comes out, and over a 2 weeks time frame the stock gets punted 50%. So it's not a great conversation. But like I said, go back to the beginning or the question earlier. Buy-siders don't necessarily use our call unless you're making kind of a bold call. They're using you more for your knowledge of the company, the industry. They're less inclined to kind of say, you're the only reason why I bought this stock, so you were wrong, so I'm never calling you again. But there's times that, if you're wrong more often than you're right, you kind of get viewed as a contra-indicator, and sometimes buy-siders will sell everything that you recommend. It's just kind of weird like that. It's just one of those ones where, like, we have an analyst at Raymond James. I'm not going to mention who he is, but there's some buy-siders who are like, yeah, every time every time he does something, they do the opposite. So it's that's just the reality. It's I think it's difficult. It's tough to manage those expectations, but like I said, if you're right more than you're wrong, it's okay. If you're consistently wrong, then you're probably not going to be employed.
How do you quantify negative market?
Great question. Well, I think price targets should generally be viewed as what you think, you play in fundamentals are the most important part of the price target. So if you think this industry has traded at 7 times EBITDA over the last decade and nothing has fundamentally changed in the industry and your growth rates are unchanged and everything's unchanged, you're going to use probably a 7 times EBITDA for your price target. But if you're thinking that, well, maybe this starts to be an impact on the stock, we're going to use a 6.5 times EBITDA or 6 times multiple. So you can kind of judge it. It's more, I would say, the sentiment issue is more so kind of a stickiness associated with sell-side research. Sell-siders don't like to be upgrading and downgrading a stock on every market move. So, I know the stock, I know the market's going down over the next week. I'm going to downgrade it, but then I'm going to re-upgrade it, a week later, and I'm going to say it's a great call because I caught it at the low. The buy-siders typically hate churned recommendations. You have a call, and you stick with your call, and if sentiment change or the fundamentals about the company's change, then you make a change. But typically being reactionary on just the market as a whole is not what clients want. The clients want to know, well, if the market's going down, which one do you want to own versus the others? Because we can long that one and short the other, and we can pair it and make a trade in terms of return differential. So, I'm not the biggest fans of price targets. Like I said, we have to put them on our stuff. But to be honest, I can tell you what my earnings estimates are. I can tell you my revenues, growth rates. But if you ask me what my price target was on X, Y, Z, I probably wouldn't be right. No, that's a great question. Right after, in end of June, when the Supreme Court ruled that healthcare reform was constitutional, a lot of the hospital stocks, they're the biggest beneficiary of healthcare reform, rallied significantly. They were up 20% over kind of a week time frame. But we actually, early July, downgraded all the hospitals because we thought the election was the bigger issue, because if whoever wins the election, you could have outcomes that change if reform stays or goes. So I think sometimes you have to be political with regards to thinking about the fiscal cliff. So for Medicare stocks, obviously Medicare is a big piece of the federal government's deficit problem. There's perhaps some reimbursement cuts coming regardless of reform stays or goes. So yeah, Medicare stocks today are trading at a discount relative to the historical norms because people are valuing in potential reimbursement cuts. They're saying, hey, your 2014 EBITDA number is probably wrong because they're going to implement the 2% rate cut and you guys are going to lose 30% of your EBITDA. So you do have to look at exogenous factors like thinking about fiscal cliff, about sentiment. But from a fundamental standpoint, investors tend to look at better. Investors are calling you more on fundamentals of the business, not what your prediction is on the election. Yeah, well, certainly what QE3 does is effectively continues the kind of the market rally. So stocks that have higher beta, that are more volatile, perhaps that have more leverage, are likely to outperform in a market up versus more of a wobbly or market down. So the big cap, boring, safe value plays are likely to underperform over the next 3 to 6 months if the rally continues relative to some of the higher beta names. So in my coverage, there's like a drug distributor, a CVS or a Caremark, or CVS, Caremark, or a Walmart, or a Walgreens. They're probably going to underperform some of these hospitals who are much more exposed to volatility. So, you can, I would never probably make a recommendation change on, well, market's going to continue to go up, so I'm going to upgrade all my hospital stocks. But when I'm talking to investors, I'm surely going to say, hey, we don't want to fight. We might be neutral in the stock, but these stocks are probably going to still go up given this dynamic. So I think you kind of, what's written in terms of your formal recommendation, well, obviously you're always pushing or going. You're never going against your formal recommendation, but there's certainly wiggle room surrounding. Hey, yeah, I have a buy on it, but might be time to take a little bit of profits, kind of based on the outlook, so to speak. And then kind of a last example of kind of looking at kind of asset value and putting all the pieces together. We had a hospital company called Health Management Associates. They're a huge for-profit hospital chain, $6 billion of revenue. They're located down in Naples, Florida. They paid a big special dividend back in 2007, levered the balance sheet, so they basically did a kind of a public recap. Instead of taking the company private, they just gave a big special dividend out to shareholders. But unfortunately, you increase your leverage profile at the absolute worst time. You know, the recession occurs. You know, hospitals' fundamentals weaken. They're at risk for debt default. So the stock goes from, I think, pre-dividend it was like $22, post-dividend was $12, and it fell to like $1.98, I believe, at the low, based on concerns surrounding their ability to stay alive. We went down there. They hired a new management team. Me and John, my boss, went down to headquarters, met with the whole team, kind of built a multi-year view of the company. We stress tested. We took management assumptions and we cut them in half. And even under those worst-case scenarios, their covenants weren't breached. And even if they were breached, you know, a bank doesn't. You know, the banks are usually rational. And they don't want to run a hospital. They'll give these companies wiggle room. But during the height of the recession and the fear factor of late 08 and early 09, everyone was just selling. Even if so the multiple got severely depressed. So we took it to a buy on a thesis that, you know, hey, once people realize that this company isn't going bankrupt, that the covenants aren't going to be breached. There is significant asset value in the company, given that it owned all of its real estate. So there's certainly value there. Once you kind of put that together, you know, it was a risky call, but we made it, and certainly it went back to $10 over an 18-month window, and it was a pretty good call. So, you know, I think, you know, you got to sometimes think outside the box when sentiment is low. That's the typically best time that you want to kind of do homework on a name. Because those are the ones that are probably going to be the most rewarded. So, you know, sometimes you can get stuck in a kind of a value trap. So if sentiment is low, maybe it's low for a reason. But if it's not low for a reason, it's just low for kind of a sentiment standpoint. You know, doing homework on that name and making a call on that name probably has the most upside as kind of a nice little call. You know, kind of the good and bad of the RA career track. You know, the pros, like I said, you kind of have a lot of responsibility. It's certainly, if you want exposure and your goal is to, hey, you're going to be an RA for 2 or 3 years, but then you're going to move to the buy side or private equity or hopefully get promoted to be an analyst or something along those lines. It's a great starting point to build your platform. You know, you get to interact with buy side and management, so you do have visibility, which helps with networking. It doesn't hurt to become a very good writer. You know, when I started 7 years ago, I was probably a subpar writer, and I'm probably just par now. I'm not above average, but certainly my writing has improved, and certainly writing is a key asset to have going forward. And it builds a lot of skill sets, verbal, written communication. So it's certainly a good thing. On the negative side, you know, if you're in sell side, like I said, you know, I cover 36 stocks, but that's not the typical you know, when I was, you know, most RAs cover 12, their analyst covers 12 to 17 stocks. So you're going to know a lot about 12 to 17 stocks, but that's about it. You know, so unless you are really into the markets and you're studying other companies as well with your own individual portfolio, you're not going to know extensively outside your coverage universe. So it kind of limits your opportunity. So if you want to go to the buy side and they're asking for a generalist, well, I know, you know, hospitals. Do you want to hire me? So it's one of those ones where it's you know, it's a challenge. Secondly, from an advancement standpoint, you know, there's very few RAs that get promoted to become analysts. It's a difficult uphill battle, and it's multiples of reasons why. You know, most firms don't like to basically start new sectors. So you know, typically they have the sectors that they want to cover, and they have an analyst who covers it. So if your analyst is 35 years old, you know, unless he's going somewhere else and they think highly of you, they're going to probably hire someone else other than promote you from within, because you don't have the skill set yet to be a full-fledged analyst. So it's really more luck of the draw type dynamic in terms of promotion within. The schedule can be unpredictable. Some days can be very boring. Some days can be, you know, earnings season. You know, there's people who sleep in the office, so it certainly can be hectic from that predictability standpoint. And like I said, I was lucky to have a great analyst. So from my view, I was given a lot of responsibility. But like I said, if you get stuck with an analyst who is more controlling, it probably limits your opportunities. And yeah, just if you can't overcome all the data flow that comes at you, it can be challenging. So just lastly, in terms of some career advice, I think research is not for everyone. It's certainly it's what I love to do, but it's a different skill set that you need to have to kind of enjoy it. Use the Gator community on Wall Street. It's certainly growing dramatically, and I'm happy to help any of you. Email address is fine. Shoot me an email. I'm very responsive in terms of getting back. Career advice. Hey, who do I send a resume to? Hey, do you have any questions on interviews? I'm very receptive on that front because I utilized it and it was very helpful when I was getting to where I am. So I'm willing to pay back the favor. Don't overlook writing. Certainly, you might think the answer is always the most important thing, but kind of writing and communicating is very important. So in classwork, writing is important. Just make that my boss. The first week he gave me an English book to read. That was my first assignment for him, was to read an English book because he was an English major, and make sure I wrote exactly how he wanted things to be written. And your first job doesn't have to be your last job, but you always want to work your hardest throughout the process. If you want to leave and go somewhere else, like my boss John, he'll be an excellent reference point for me forever. So. As long as you work hard for him, he's not going to demand you to stay there forever. He knows that. So, it doesn't have to be your last job. So when you're doing this process, maybe you don't get the best job that you want, but it doesn't have to be your last job. And then I would just say don't compromise yourself. Certainly there's morals associated with research and dealing with investors and kind of just, but that's kind of the way I would view it. But that's all I have. Yeah. Well, we weren't part of the settlement, but we still follow most of the rules with the settlement. So, Raymond, I was telling the guys at lunch, the 6th floor, which is where research is located, it's locked, so you have to have a badge to get in. So no one can get in, so banking can't come on our floor or anything along those lines. And that's why Tom James loves art, but the 6th floor has no art on it, and it's pretty mundane because no one's allowed in, so he's not gonna staff beautiful pictures on the walls for research. But we're not allowed to email directly, so it's another thing we can't do. But there's a lot more communication done phone, and we can have lunch and things along those lines. But I would say physically, there's probably not much difference from what we do relative to you go to J.P. Morgan. But the rules that we have to abide by are different, so therefore we can use our bankers' network to our advantage. Uh-huh.
What are the terms buy, sell, and hold mean? Are those well-defined terms or something that you should ignore?
Well, it depends on which firm you work for. So Raymond James actually, something I don't agree with, but we have four. We have strong buy, outperform, market perform, and underperform. So the strong buy, there's a criteria where you expect that stock to outperform the market and go up more than 15% over a 6-month time frame. Outperform is it's going to outperform the market and appreciate more than 10% over a 12-month time frame. Market perform is it's going to perform in line with the market with a kind of 10 to plus 10 minus 10 window. And then sells are ones that are going to underperform the market and be down, I think, 15% over a 12-month time frame. That's the way Raymond James structures their research criteria. Other firms that just have buy, hold, and sell, it's a buy if your price target is more than 15% above where the stock is today. It's a hold if it's plus or minus 15%, and it's a sell under 15% of where your price target is. That's generally speaking.
So it's more normal for firms not to be like market index, like Raymond James' recommendations
Yes.
are based on how the market.
I would say that's what Raymond James's definition is. Is it necessarily a buy to buy? That's probably the first question I've ever had if someone asked me about what our research regs were in terms of, if you like a stock a lot, I guess you put a strong buy on it. I'm not too big fan of the fork system classification, but typically, that's the way the whole industry works. Is plus 15 is buy, and then sell is under 15, and everything else is in between. But like go back to original, sell side, or excuse me, buy-siders really they don't say, oh, well, you know, I'm not going to talk to you because you have a market perform on it versus not. You know, they don't really care what your rating is. Yeah. Uh-huh. Well, you have a lot of clients shorting my buy recommendations too. They just want to talk to you regarding your knowledge, and they make a decision surrounding their own view. But they want to get. So if you're a buy-sider and you're looking to, do I want to invest in this company or not invest in this company or short this company, you're probably going to talk to the analyst who's got a buy on it, one that's got a sell on it, one's got a neutral on it, and kind of get a sense of what the bear bull case is, and you make your own decision. So I could talk to someone who I know is short one of my buys, and I'm happy to talk with them because, you know, we're just having conversation. So, yeah.
So you don't take into account the possible volatility at all, even if the expectation is very high, because perhaps exposed to a lot of volatility, maybe from a binary event, does that lower your rating?
I would say the volatility standpoint, well, maybe the comment I made earlier was perhaps a little bit unclear, but if I think the market's going to be going down over the next 12 months, I'm not going to take all my stocks to a sell. It's just not the way it works. It's more of relative calls relative to other calls within your space. But if there's a binary event and I have a buy in the stock and I think expectations might be too high on a positive outcome of that binary event, I might cut the hold because I'm not willing to accept the risk reward at that price point. So yes, I do take into account the binary event, but if I'm just a market call, I'm not going to make a stock call off a market call.
Technicals come into play at all, or is it all fundamental?
Technicals do. We have a technical analyst at Raymond James who, if you have questions, he'll help you. He's making his own calls on, and they could be contra to our fundamental call. But I look at the charts, yes, before I make a big call change. Certainly I don't want to, if they just broke its 50-day moving average to the downside, I'm not going to try to upgrade, fight the technicals. But I wouldn't say I'm a huge technical analyst, but it's something to be aware of when I talk to my trader every day. He'd be like, yeah, the stock just cracked the 50. It's going to be down. Those types of things help to understand. But are they going to be the fundamental driver to our kind of research? No. Yeah.
Another question that come across. I don't know if it's worth it or not, but my sense would be that if last time person talked to you, I would love to know what those two binary events are. How the company would be affected in both those scenarios, and I'll decide the probability. I'm not necessarily asking you to,
Yeah.
especially in an area where those.
Yes. Yeah. They're asking me. Hey. Yeah. They're asking me if President Obama is reelected, what do you think the multiple of the hospital stocks? It's at 6.5 times EBITDA today. Does it go to 7? Does it go to 7.5? And why does it go that way? They're not making me to make a call on that specific. I could change. And like I said, we downgraded the hospitals back in July off the healthcare reform highs because we're like, hey, yes, we got through one potential risk, but the election is the bigger risk. So I think expectations are high. Let's cut the rating. But the binary event side of things, yeah. The buy side uses sell side more so of just framing the company, the risks, the opportunities, where your thought process is differentiated relative to the other 25 sell-siders who cover it, and they'll make the ultimate decision on if they buy or sell. That goes kind of go back to the original comment that, I don't think I've ever had a buy-sider ask me what my price target was. Yeah. In the healthcare space, because I can't ask for, for healthcare, I couldn't say there is, but I probably am not the best to answer that question. I apologize. That's a good question for me you stumped me. It depends on the stage of the company. So for a CVS or a Walgreens, yeah, we're looking at earnings multiples over a 2-year EV to EBITDA. We're not typically doing DCFs. But for some of these small diagnostic companies that aren't profitable today, but they're trading at 6 or 7 times revenue, buy-siders want to know, is it fully priced in of the potential cash flows? So you might use a DCF for a company that's like in the startup phase to kind of get a better sense. But typically, typically most analysts are derived off of multiples. They use multiples. There's some Raymond James analysts who love DCFs, and all their price targets are based off DCFs. And everyone can have their opinion on discount rates and terminal value. So it's really difficult to tell someone about you can. I would mention to the buy side, hey, I think the street's underappreciating this company's free cash flow. Look, it's growing faster than earnings because of their NOL. Those types of things are relevant, but from a DCF standpoint, I'm not a huge DCF guy. Most of the buy side isn't either, from that I directly. But healthcare is different than other spaces. Yeah, well, you look at a lot's changed over 10 years. You might look at a shorter time frame. But hey, this company's traded at, on average over the last 5 years, 7 times EBITDA, or the industry is traded at 7 times EBITDA. And right now they're 6 times EBITDA, but there's nothing fundamentally has changed relative to 12 months ago. Perhaps that's a stock that you think might be undervalued relative to historic level. There might be a reason why it's 6 times EBITDA. It might be, hey, their growth rate is slowed, competition is setting in, and maybe 6 times is the right number to use. But typically you kind of look at historical multiples on both an EBITDA, free cash flow, PE basis, and kind of project those onto your forward estimates to kind of derive if it's a worthy buy or sell. Well, obviously for a diagnostic company, there's a lot of scientific data out there of the sensitivity and specificity of a certain assay, and is it successful at diagnosing or telling you if you need chemotherapy or no chemotherapy, for example. So from that respect, I'm utilizing more of the published written literature that's in the Journal of Medicine and things along those lines to derive conclusions surrounding that dynamic, and then layering that into, well, wow, this is a really sensitive and specific test that really says what it's going to do. This could be a novel instrument that can be used, for years to come. I think this is going to accelerate their revenue growth profile once the market starts to better understand the technology. So that's kind of how I would. But certainly there's doctors out there who. Some of these firms out there hire actually doctors. Doctors work for them. Buy-siders. So there's an increasingly number of buy-siders who are former MDs, particularly in the healthcare field, where they're utilizing their specific background to make judges on, is this stock going to do well or not. So it really just depends on your background. Does that answer your question, or? Yeah, well, it's always a difficult conversation at least for me, when I'm not a doctor, obviously, and calling a buy-sider who is a doctor, and I'm trying to tell him about, this tech, I wasn't implanting this, but maybe you were, and you know more about I do. So those are always a little bit more different conversations. But for the most part, what the buy-side will do, will listen to what you say, double check it or confirm it with their own sources, and then build their thesis off of that. Thank you.
You know,